Dear students, this is Shrikant Yan, Assistant Professor, Maharani's Commerce and Management College, Mysore. In this session, I am going to explain the first chapter of Corporate Accounting prescribed by University of Mysore. The first chapter you have is issue of shares. Here you have to understand the meaning of share capital, and after knowing the meaning of share and share capital and different terms which comes under the particular topic, in this session I will try to make you to understand the various accounting entries which is to be recorded in the books of account of company when the company issue the shares. Students, now start with the meaning. The meaning of shares. Share is the share of share capital, or we can say that share is the segment or a unit or a part of the share capital. So the company, that is a joint stock company which is registered under the Companies Act of 1956, if they want to raise the capital, one of the mode of raising the capital is issue of a shares. So to know the meaning of share capital, first of all we have to understand the meaning of share. The share is the share of share capital. Next, we have to understand the meaning of share capital. Share capital is the capital which is raised by the company by the issue of the share. After knowing the meaning of share and share capital, you have to understand the different types of shares. The company will going to issue the two different types of shares. The one is called preference shares and another one is called equity shares. Now let us see the meaning of preference shares. Preference shares are those shares which have the preferential rights in the matter of getting the dividend and in the matter of repayment of capital at the time of liquidations. So those shares which have these preferential rights, that is getting the preferential right with respect to dividend and repayment of capital at the time of liquidation, that shares are called as preferred shares. The next shares we have here equity shares. Equity shares also called as ordinary shares. These shares are those shares which is issued by the company, and these shareholders are called as the real owner of the company. These equity shares can be issued for cash as well as other than consideration of cash. So those equity shares which are issued other than consideration of cash, they are called as bonus shares. That is the meaning of preference shares and equity shares. Next we have to understand what are the different types of share capital. There are 5 different types of share capitals are there. Actually it is called different names of share capital. One is called authorized capital, issued capital, subscribed capital, called up capital, and then paid up capital. In simple one line answer, I will going to give the meaning of these all types of 5 types of capital. Authorized capital are those capital which is authorized by the capital issuing authority to the company to subscribe the capital from the public to the maximum limit. That means when the company get registration, at the time of registration in its MOA, that is a memorandum of association, they have to mention how much of authorized capital they required. So in the object clause, what is the amount they have mentioned, what is the number of shares they have mentioned, that share is called as authorized capital. Means up to that limit, up to that quantum, they can issue the shares to the public. Over that they cannot issue. That is the authorization they will get from the concerned authority. Next one is issued capital. So what are the authorized capital they have? Out of that authorized capital, they are going to issue the capital to the public. Actual issues what they have made to the public, it is called as issued capital. Then subscribed capital. Subscribed capital are those capital out of issued capital. Actually, how much of shares has been subscribed by the public, that capital is called as a subscribed capital. Then is called called up capital. Called up capitals are those capital wherein out of total subscription, the company need not to call all the shares to invest in the company. As per the requirement at different stages, they are going to call up the capital from the public to make the investment in their company. So how much of shares they have called up to the public, that is the subscribers, to make the investment in the company, that part of the capital is called as called up capital. The last one is paid up capital. So when the company make the called up capital from the public, all the public subscribers, the share subscribers, will not make the payment. So ultimately, how much of actual amount they receive from the public out of the total called up capital, that capital is called as paid up capital here. So these are different types or the names of share capital which is mentioned in the balance sheet. So here at the time of subscription, it's a very important provision we have to notice here. There are three different of subscriptions will be there. One is called minimum subscription, over subscription, and then under subscription. These three terms you have to understand to have a better knowledge about the issue of shares and the share capital. Minimum subscription, as per the SEBI guidelines of Amendment Act of 2013, every company when they issue the shares, before issue of the shares, there must be a 90% of the share which are issued to be subscribed by the public. Then only the company will get the permission to issue the shares. So that minimum amount of shares which is to be subscribed by the public, that is called as a minimum subscription. If the 90%, for example, take if the company issue the 10,000 shares to the public in its initial public offer, that is called IPO, then out of 10,000, 9,000 shares to be subscribed by the public. If 9,000 shares subscribed by the public, it is called minimum subscription. If the 9,000 shares are not subscribed by the public, then the company is not supposed to issue the shares to the public. Then oversubscription. For example, take company issue 10,000 shares, but the public subscribe more than 10,000 shares. Apply for more than 10,000 shares. Application received is more than 10,000 shares. Then it is called oversubscription. Under subscription. For example, take company issue 10,000 shares applications, but the public subscribe only 8,000 shares. It means public applied only for 8,000 shares. That is called under subscription. These are the different types of subscription we are going to observe in the process of issue of a shares. Minimum subscription, over subscription, and under subscription. Dear students, after knowing this, the types of shares, share meaning and the share capital meaning and the subscription meaning, next we have to understand the different accounting entries which has to be recorded in the books of account of a company when the company go for issue of shares. In this process of issue of a shares, the accounting entries are very important. So in this session, let us understand what are the accounting entries which is to be recorded in the books of account when the company go for issue of shares. there are different stages where we need to make the different entries. We have to pass the different entries in the books of account. The first transaction is like this. There is general entries relating to issue of shares. For receipt of application for shares together with application money, means the company issue the shares and collect the money in 3 different stages: application stage, allotment stage, and the call stage. So at the time of application stage, when they receive the application money along with the application, when they receive the application along with the application money, the accounting entry will be bank account data to share application. So here bank account data to share application. This bank account is debited, share application account is credited. Second one is, for the application money on the number of shares allotted is transferred to share capital account. So whatever the application money you are credited, out of that share application money which is credited, that application account should be debited, and again the amount should be credited to share capital. For that, journal entry will be share application account data to share capital account. So after you transfer the share application money to share capital, the next entry we have to pass in the books of account is allotment money due. The second stage, allotment stage. In allotment stage, we have to pass 2 entries. One is allotment money due and the allotment money received. So for allotment money due, the entry will be share allotment account data to share capital account. And for the allotment money received, when the money is received, automatically, so bank is the receiver, so bank account data to share allotment account. Next, the third stage is, that the third stage of collecting the share money is call stage. So under the call stage, we are going to pass the 2 entries. One is for due entry, another one is for received entry. For call money due, share call account data to share capital. There is the entry we will make in the books of account. Here share call account will be debited and share capital account will be credited. So the share call money is received. Then the share call money is received. The accounting entry will be bank account data to share call account. Okay. So whenever there is a receive, commonly you have to think when the amount is receiving, the bank account should be debited, because bank is the receiver. From which account you are receiving the amount, that account should be credited. Okay. So these all the accounting entries we are going to pass when we make the issue of shares in the company. So that's, I will going to wind up this session, students. I think you understood the meaning of share capital, types of shares, and the types of share capital, and all the entries with respect to 3 different stages: application stage, allotment stage, and call stage. I think you have understood. So thank you.